Welcome, everybody, and thank you for joining me today. I am Elizabeth Sporer, and this is TTT3, Following the Money, our financial fitness workshop for A&D leaders. Quick housekeeping. This is a 60-minute session. We'll save time for Q&A at the end, but feel free to drop questions in the chat as we go, and I'll work them in where it makes sense. So let's get started. Here's our roadmap for the hour. After a brief intro, we'll talk in part one about who's actually minding the money at your firm and where that breaks down. Part two, the handful of metrics that actually matter with real formulas and reference examples. Part three, how to build the systems and habits that make financial fitness sustainable rather than a jumble gym. And then we'll close with open Q&A, so let's dive in. A little about who's running today's session, since some of you haven't met me yet. I am Elizabeth Sporer. I've founded SoArc, a fractional COO and business strategy practice built specifically for A&D firms. Before this, I spent 25 years and more on the inside of the mid-sized and large A&D practice itself. At EHD, Lowney Architects, Sherwood Design Engineers, Studios Architecture, Perkins and Will. So running everything from project delivery to bicontinental operations. I am a licensed architect, a certified integral coach, and I have taught professional practice at the California College of the Arts, and I've been working with over 50 clients since I started my business 9 years ago. So I look at these topics from both the practitioner side and the academic side. I'm telling you this not to read you a bio, but because it's exactly what the session exists, because it's exactly why this session exists the way it does. I've sat where you're sitting, trying to design well and run a business at the same time, often without anyone showing me how the financial side actually works. That's what today is for. I also have a monthly newsletter. I hope you have subscribed to it. If not, take a QR shot, a QR image in the upper left corner and subscribe. I have been doing over 25 events by now, but any topic you can imagine about running an A&D business. So who deals with the money and how? I ask every group this question, and most firms don't have a clear answer. It's usually some version of, well, me when I have time, or whoever is available. And that shows up in late invoices, in P&Ls nobody reads, and tax until the tax season, I guess, and in principles doing collections work at 9 p.m. But here's the thing. Financial fitness is exactly like physical fitness. It's not a once-a-year audit. It's an ongoing practice. That's what the whole session in one sentence is about. Let's unpack it now. So who's minding the business? Let's get specific about roles, because vague accountability is where all this starts to break down. So this is a typical mid-sized setup, and I want you to see yourselves in this whatever size firm you're running. You've usually got a principal or two, maybe a director of operations or office manager, sometimes an outside bookkeeper. On paper, that looks fine. The problem isn't that the roles don't exist. It's the cracks between them. So let's get specific about who should actually see what. The principal needs the full picture, the complete P&L, cash position, plus every KPI we covered today. That's non-negotiable. It's the job. The director of operations or office manager needs the operational layer underneath it, utilization by team, AR aging, project status, enough to run the day-to-day without needing to ask permission for every report. Your big bookkeeper or outside CPA needs the transactional detail, the ledger itself, but they're not your strategic partner. Don't mistake clean books for business insight. And here's the one most firms get wrong. Your studio and project leads should see their P&L for their own projects and the utilization numbers for their own teams, not the whole firm's financials, just their slice related to their studio or their projects. That's enough for them to manage well. Without withholding even that much is usually what creates the visibility gap we're about to talk about. So it's not that financial data exists somewhere in the building. It's that it isn't reaching the people who could actually act on it. And that last point, the delegation question, is one I want you sitting with. So what is still on your desk that doesn't need to be? So 3 patterns I see constantly worth naming out loud. There are 3 patterns. Number 1, the visibility gap. The data exists, it's just not getting to the right people. And number 2, partnership dynamics. When 2 owners split financial responsibility or don't, these gaps compound quietly over the years. And 3, if you are not the owner in this room, and here is what you should reasonably expect to see. A monthly utilization report for your team. A project level profit and loss statement for whatever you're running. Project status shown with monthly results, year-to-date, job-to-date data on fee budget, fees spent, fees billed. A very high-level dashboard summary of the firm-wide KPIs we'll cover today without needing every line of detail behind them. And a pipeline or backlog snapshot, which will allow you to know what's coming at your team before it lands. What you do not need and shouldn't expect is partner compensation, draw structures, or firm-wide bank balances. That's not withholding. That's just a reasonable line. Ask for the first 2. That's a complete reasonable ask. So the same question, who deals with the money? But the honest answer depends entirely on your firm size. Solo and small firms, it's the principal trap. One person doing design, sales, and collection. The mid-size, the 15 to 75 staff range size. The roles exist, but the wiring between them is incomplete. That's most of you in this room, from what I saw on the sign-up sheet. Then the larger firms, 75 to 150 plus staff. You usually got a real finance function, but the gap shifts to getting that data out to the studio floor to the right person. So it's again the gap that is that creates this invisibility. And there is a variation on the larger firm picture worth naming separately. Firms with multiple office branches. Financial management and accounting are almost always centralized. One finance team, one set of books, often sitting at headquarters. But that centralization doesn't mean equal access. Information reaches branches and branch heads unevenly. The branch closest to headquarters, or the one the managing principal visits most, tends to see more than a satellite office 3 time zones away. Centralized doesn't mean distributed. So if you're running or reporting into a branch office, that's worth asking about directly. Wherever you are on the spectrum, single office or multiple, 5 people or 150, I want you to locate yourself before we move into the metrics. So part two, the metrics that actually matter, with real formulas and not just the vibes. Before we get into the formulas, let's make sure we're speaking the same language. So 5 terms that show up in these calculations. I want to give you a terminology behind it. Net revenue, so the gross revenue minus reimbursable expenses and consultant fees you're passing through to the client. So this is the number that actually reflects your firm's work, not money moving through your books on someone else's behalf. The second one is direct and indirect labor cost. Direct is time billed to projects, the work clients pay for. Indirect is everything else: marketing, admin, training, PTO. So every hour your team works falls into one of these 2 buckets. Direct labor cost is actual wages paid for hours worked on a client project at each person's standard pay rate. And the pay rate is the annual raw salary divided over 2080. Then the operating cost, direct and indirect labor plus other not project-specific operating expenses combined. This is everything it costs you to run the firm, full stop. Then we look at overhead cost, which includes rent, software, insurance, indirect labor, everything that isn't direct labor. So this is the number that creeps up quietly as firms grow. It can be calculated simply by operating cost minus direct labor cost. And then the operating profit, so net revenues minus operating cost. What's left after labor and overhead are covered? This is the number that feeds directly into the first KPI on the next slide. So keep these 5 in your head. Every formula on the next few slides is built from them. So what you're looking at here is an abbreviated profit and loss statement. You can see the net revenues at 100,000 in the third line. That's the total revenues minus the direct expenses. You see the direct labor cost at $33,333. The indirect labor cost at $21,334, and the operating profit at the bottom at $10,000. Payroll-related expenses and other indirect expenses in between. Other indirect expenses could be rent, insurance, etc. IT. So these are the 5 KPIs every A&D firm should be tracking monthly, regardless of size. Operating profit rate, net effective multiplier, overhead rate, break-even rate, and utilization rate. I'm going to walk you through each of these with real formulas in the next slides, but I want you to notice something. These aren't abstract. Every one of these you can calculate today, this afternoon, with numbers you already have or should have. So let's make this connection concrete with a real world example. Industrial median samples numbers, excuse me. You see again the abbreviated profit and loss statement with reference numbers pasted to the right of the slide. So we're looking at operating profit rate. So the $10,000 in operating profit is divided by the 100,000 in net revenues, resulting at 10%. That's your operating profit rate. Utilization rate as the next one tells you what percentage of your team's total working time is actually being spent on billable client work. The formula is direct billable hours over total hours worked, or direct labor cost over total labor cost. What it indicates in practice is a utilization rate of 65% means that for every 10 hours somebody is at work, 6.5 are billed to a client project and 3.5 go to everything else. Admin, internal meetings, marketing, PTO, training. That 3.5 hours is your overhead in human form. So again, how it is calculated. You have 33,000 in direct labor cost against 54,667 in total labor cost, resulting in a 61% utilization rate in this case. The next one is the net effective multiplier, which tells you how much revenue you're generating for every dollar of direct labor you pay. So it's the clearest single number gut check on whether your fees and structure are actually working. To calculate it, the net effective multiplier, in this case, you take the $100,000 in net revenues over 33,333 direct labor costs, resulting in a 3.0 multiplier. What it means is that for every dollar you pay someone, you're billing 3 in this case. That spread is what has to cover the overhead cost, indirect labor cost, and leave room for profit. So the multiplier is really answering one question: is what I'm charging enough to support the business built around the person doing the work? And we look at the break-even ratio in a few minutes. So if the net effective multiplier is higher than the break-even ratio, you're making profit. That's the simplest way to look at how am I profitable or not. The next one is overhead rates. It tells you how much it costs to support every dollar of direct or billable labor with everything else it takes to run the firm. It's calculated, in this case, the 56,667 overhead cost over 33,333 direct labor cost, resulting in a 170% rate. An overhead rate of 170% means that for every $1 you pay someone in base wages for billable work, you're spending another $1.70 on everything non-billable: indirect labor, PTO, admin, marketing and training, payroll, taxes and benefits, rent, software, insurance. So it's the cost of the infrastructure standing behind every billable hour. And now the break-even rate. It's simply calculated by overhead rate plus 1. In this case, 270%. The last number is the one that surprises people most. You have to bill $2.70 for every dollar of direct labor just to break even. Not even making any, just to cover all the expenses and, and keep the door open. Here again, I made a summary slide of the 5 KPIs we just looked at. KPIs, key performance indicators. Operating profit rate, 10% is operating profit over net revenues. Utilization rate, 61%. Direct labor cost over total labor cost. Net effective multiplier, 3.0, is net revenues over direct labor cost. Overhead rate, 170%, is overhead cost over direct labor cost. And break-even rate is 1 plus overhead rate, what you must build to break even. So the direct labor cost is actually in almost every one of these factors, as is the net revenues. Now that you got the formulas, here's what healthy actually looks like across the industry. Utilization in a range of 65 to 75% is considered good, sustainable, and profitable. Smaller than 65% means that staff have more capacity than the firm has billable work to fill it with. And larger than 75% means almost all of someone's time is going to billable project work. That may lead to burnout and turnover. The net profit margin of 15 to 20% is considered good in the A&D industry after all expenses are taken out. Days sales outstanding should be preferably under 45 days. That's how fast you're collecting after you send out an invoice. Now, I understand if your firm is working with large municipalities or is possibly as an architecture or a design firm hired by another architecture firm or contractor, that collection time of 45 days can easily double to 90 days. I'm not saying you should not do that kind of business, but you need to be prepared that you need to keep at least 3 to 4 months of operating costs at hand to cover your work before you even get paid for what you do. Which leads to the next line item, the days cash on hand. It should be over 60 days. I would say 2 to 4 months is advisable to have cash at hand operating costs. So you need to know what your monthly operating cost is, of course. And then the last one, the break-even ratio is typically between 2.0 and 3.5, and that's depending on the firm size. Small firms are usually within 2 and 2.5, mid-sized firms between 2.5 and 2.9, and large firms often between 2.9 and 3.5 or even above. I want you to point you to the AIA Firm Survey or PSMJ and Zweig-White's benchmarks. They're already on your resource slide for defensible numbers. They get updated annually or biannually. So the same 5 KPIs, but how you apply them depends on your firm size. If you're solo or small, don't overbill. Just track a few of them by hand. The utilization rate, AR aging, and net effective multiplier. The number doesn't need a system yet. It just needs a habit that you really check on it and track it. The mid-sized firm, this is exactly where these metrics earn a real dashboard and where someone other than the principal should be able to read it with you. Larger firms, you still likely have the numbers already. The real work is distribution, getting studio leads their slice instead of just the firm-wide metrics or totals. So here we look at a simple dashboard for a small firm with 5 employees. You see the net revenues shown in the blue bars in the upper left corner. Operating profit rate shown in the gray line in the upper left corner's graph. Utilization rate in the blue line in the upper right corner's graph. NEM in the orange line on the lower right corner's graph. Break even as a gray line in the lower right corner's graph, and operating cost per month as an orange bar in the lower left corner. It shows also the revenue per staff as a gray line, lower left corner. Produced per staff. Actually, excuse me, the number of staff, referencing to the scale on the right side of the left graph. So here we look at the chart that feeds the graphs of the previous slide. It goes into more detail on the expenses by type. Generated in Excel, it shows net revenues, operating profit rate, utilization rate, NEM, break-even rate, and operating cost per month. I've generated firm and project performance dashboards for many small and mid-sized firms and can share visuals with you if you're interested. Please schedule a call to review if you're interested. Getting to part 3, so building the habit, the systems that hold all of this up. So here's what a monthly financial review actually looks like in practice. It should be 90 minutes long, preferably in the last week of the month. Principal plus operations lead if you have one. 10 minutes on revenue and profitability, net revenue, operating profit rate, overhead rate. 20 on cash and collections, like AR aging, days cash on hand. 20 on utilization and capacity by T, if you can. And then 30 on project status and project level P&L. Which jobs are actually making you money, and which ones are making you lose money, and why? And then 10 minutes at the end, the most important part, deciding what changes for the next month. So this rhythm is the whole game. So what throws a firm off its financial fitness? Internally, it can be scope creep, understaffing, uneven utilization across teams, things inside your control. Then externally, it can be client concentration, market cycles, interest rate shifts, things you can't control, but you can prepare for it. And the tool that catches both before they bite is cash flow forecasting. It's not just an accounting exercise, it's a leadership tool. Here, look at a template-based, best suited for small firms with less than 10 staff. Each project is shown in one row and fees projected or actually billed per month in each columns to the right. So you can see the actual backlog, projects in contract on the upper part of the spreadsheet, and the pipeline of prospects with fees in the lower part. The spreadsheet uses potential revenues built on fee potential as a reference to check whether the backlog is within reasonable variance to the firm's billing potential. Now, how do you know what your firm's billing potential is, you may ask? All right, here we go. So here you look at an employee roster of a firm with 5 employees. Each employee is listed by name, billing rate, title, annual compensation, billing rate, and target and actual utilization, and whether it is a full-time or part-time employee. So the annual target revenues or billing potential can be calculated by multiplying billing rate with utilization rate by 2,080 hours for the year. And then adding all the 5 employees' target revenues up adds up to the firm's annual billing capacity, which in this case is $810,680. Divided that by 12 offers a monthly billing capacity of $67,557. Again, I'm going back. So this is actually added as a potential revenue line, but mid-screen, right below the actual backlog line, as a line item per month. And then the variance below calculates the difference, how the actual kind of billing or the projected billing compares to the potential, and makes an assumption of how many staff the firm is either over or undersized in the row below. Now here you look at the templates best suited for small to mid-sized firms with more than 10 employees. Each project is shown in a summary row and fees projected or billed per month in each column to the right. You can see the actual backlog, projects in contract on the upper part of the spreadsheet, and the pipeline of prospects with fees in the lower half. The spreadsheet also uses potential revenues built on fee potential as a reference to check whether the backlog is within reasonable variance to the firm's billing potential. Which is shown at the fourth lowest. It's shown towards the bottom of the spreadsheet. The variance is about mid-screen. Excuse me. The target is about mid-screen as target monthly total, which varies in this firm's kind of reference file because the firm probably shrank and grew along the year. And then at the very bottom, it compares the variance to a target per employee number and tells you that the firm had 6.9 to 7 staff too many compared to the billing in the first months. Then it switched in the other direction where the billing capacity exceeded where the backlog exceeded the billing capacity in the months of March, April, May, June, July, actually for the rest of the year. So they needed to hire. And here you look at an expanded view of the forecasting chart and see that each project has each phase or task listed as a row with fee budget, a start and end date with a duration. So the fees will spread out for the duration given after the given start date. And here you look at the graph representing the summaries. You can see at a glance whether your backlog meets and exceeds the billing potential or whether it is often needs adjustment. So the quick read is the first 2 months, the billing was very low compared to the potential, which is the gray dashed line with orange dots. The actual billing was, in fact, was above the backlog, but below the potential in the month of February. It's the orange dotted line with the blue cross in it, but then exceeded the potential in the months March through July, went below that for the rest of the year because it's probably still forecasted or not. Actually, the 200,000 is like a baseline assumption. So it tells me at a glance that the firm had a strong backlog has a strong backlog for most of the year, most likely will exceed billing beyond capacity and is stretched somewhat thin, should probably higher. So I want to pause on something less tangible, financial anxiety. So financial anxiety shows up differently depending on where you sit in the firm. For the owners, it turns out often in form of avoidance, not looking at the numbers because it feels worse than not knowing. So not knowing is easier than knowing how good or bad it is. It's a behavior pattern. And for everybody else, it's disconnection. Watching from the studio floor without context for what's actually happening. So naming it matters. So I guess be aware of whether you have this anxiety and how you deal and cope with it. Fitness would overcome that. So financial fitness isn't just spreadsheets, it's also being honest about how money makes people feel. All right, let's talk systems. So the pipeline that makes all of this possible. It starts with time tracking, the foundation. So there are tools like Harvest, Mosaic, Monograph, BQE Core, Agera, or Delta Vantage Point out there that lets you track time. If those entries aren't accurate, everything downstream is fiction, it's unreal. Because that data point feeds invoicing, and some of these systems or an Excel spreadsheet translates tracked hours into billed revenues. That again feeds accounting. QuickBooks Online is the backbone most small and mid-sized firms already have. And all of it should feed a dashboard eventually that shows utilization, AR aging, multiplier, project P&L, the numbers we just walked through. So larger firms may have an ERP. ERP stands for Enterprise Resource Planning. Enterprise Resource Planning, excuse me. The software that combines multiple core business functions into one connected system instead of running separate disconnected tools for each. So what it does, in the A&D context, an ERP like Core, BQE, Agera, or Delta Vantage Point typically combines several things. One is being time tracking and project management, so the hours, tasks, and schedules. Two, it combines billing and accounting, the invoicing, accounts receivable, accounts payable, and general ledger function. Three, it might combine HR and payroll. So staff records, benefits, sometimes even payroll processing. And four, it might go into reporting and dashboards. It visualizes utilization, multiplier, and overhead numbers that we have been talking about. They are generated automatically from the same underlying data. So why this matters for the systems pipeline, we covered is instead of time tracked in Harvest, then built in QuickBooks and reported on a separate spreadsheet, three disconnected steps where things fall through the cracks are kept in the same database within an ERP. So a billable hour ended once flows straight through to invoicing, financials, and the dashboard without manual re-entry. In a well-implemented ERP, anyone with the right access can pull last month's numbers without asking, because there's one system of record, and they have to have the right access, of course. The trade-off is ERPs are more powerful, but also more expensive and heavier to implement than point tools like Harvest, Monograph, or QuickBooks, which is why they tend to make sense once a firm hits a real scale, not from day one. But I have clients and had clients that started implementing an ERP when they had 10 staff successfully and also at a cost rate that worked for them. So here's what to actually use. Size to your firms, straight from my Finance 101 toolkit. Excel and Word, they're fine, but only for the smaller firms. QuickBooks, the standard at most sizes for billing, accounting, and light time tracking. Then Harvest, Monograph, Mosaic for dedicated time tracking and light project management. And full ERPs like Core, BQE, Agera, Delta Vantage Point, once you need finance, billing, HR, and PM in one system. And here's the test that matters more than which tool you pick. Could someone other than the principal pull last month's numbers without asking? I hope you found a way to give somebody that access so you don't have to be the bottleneck at everything. Now, when you're deciding how to build out these systems, you've really got three paths. You can build it in-house, have full control, but it costs you time. Or, next one, you buy a platform. It's faster to stand up, but it's an ongoing cost of subscription and of time. Or three, you outsource. You bring in fractional support. There's no hire required. So most firms with the last one honestly end up with a blend of all three, shifting as they go. There's no wrong answer here. Just be intentional about which one you're choosing and why. So I want to leave you with one diagnostic question because it cuts through everything we've been talking about. Could someone other than the principal pull last month's numbers without asking you? Sit with that for a second. If the answer is no, that's not a tooling problem. That's the system's gap to close first before anything else on this list. So that's the formal content. Now I want to hear from you. What's on your mind? Questions about your own numbers, your own setup, anything we covered today. Don't be shy. Chances are, if you're wondering about it, 3 other people in this room are too. Okay, checking. I see no hands raised. Okay, let's move on. So before we close, one action. Split by where you sit. If you're a principal, commit to one practice to install this month, not 5, 1. And if you're a director or not the owner, commit to one question to ask your leadership about financial visibility. Small and consistent beats big and abandoned. That's true of fitness and it's true of this. Quick look ahead. So TTT4 is about business development in August. And I'll say this clearly, financial fitness connects directly to ownership transition, which we have covered in our last session. If you want benchmarks to keep referencing, the AIA firm survey and PSMJ and Zweig White metrics are both solid. And my inbox is always open, elizabeth@zoarc.studio. Thanks for staying financially fit with us today. And thanks again for being here. Stay connected, scan the QR code, or reach out directly. I follow up with a recording and slides. I see you at TTT4. Thank you and goodbye.